Let's get to the broader market, the weakness we are seeing here across the board. Another sharp down day. With us now is Canaccord Genuity Chief Market Strategist Tony Dwyer. It's just brutal days like today. Barely any winners. We're now 34% off the highs in the NASDAQ. David Rosenberg, who's pretty negative, said we have to wait another year until the Fed starts cutting for this to be over. What do you think?
I don't, as you know, we've been kind of cautious throughout the year, but I think it's going to be quicker than that. Sarah, we've done this a long time. The Fed always, before they cut, is the most aggressive in terms of tightening. So the fall that we've been talking about is wrapped around the 2-year note yield. And the question that I'm most frequently getting is what bottoms, how do you create the low versus a low? And what I found is since 1960, I looked at, since it's been a 500 stock index, there has never been a time where the 2-year note yield made a new high for the cycle and the S&P bottomed before it or simultaneous to it. The median delay is about 37 weeks. The shortest is 2. So in other words, what the data is telling us is that, we were going to go make new lows. And at some point, I'm sure the UK and the Bank of England didn't think that they were going to do quantitative easing a week ago. Things unravel quickly. And when they do, the central banks tend to capitulate. And I think that'll be the case as we move into the end of the year.
But to be clear, Bank of England had to step in because they were dealing with some market dysfunction and trying to bail out the pension funds that were going to face margin calls. What we're talking about here is potentially the Fed. You're saying the Fed is going to have to blink because why? Because of the market turmoil or because of the economy?
There's always two reasons. They break something through their tightening, or you get into a severe economic weakness. Now, David was talking about hiring plans. If you look at the National Federation of Independent Hiring Plans Index, it leads the unemployment rate by 4 months. It's been deteriorating significantly, suggesting by the end of the year, you're going to have a pretty nice bump up in the unemployment rate, while inflation is already, especially durable goods and non-durable goods, inflation is already coming down. So you're going to be in a situation with a tumultuous market, the fall, weakening inflation, the 1-year, 2-year, 5-year, and 10-year break-evens are coming down, and the unemployment rate is spiking. That's hard for the Fed to not at least make what I would call a neutral pivot. But just to be clear, Sarah, there's 2 reasons that the Fed capitulated. Remember the Christmas Eve massacre in 2018? Orange County declaring bankruptcy in 1994, long-term capital in 1998, Asian economic crisis 1997, European debt crisis 2011, et cetera, et cetera. It always comes from somewhere. When they tighten like this, they break something.